All right, so in this week we had a lot of macroeconomic events. We had, in particular, what has really caught my attention was the FOMC meeting on Wednesday and the Fed's interest rate coming out at a hold as expected at 4.5%. We then later on had a Fed press conference. So now moving to their press conference and their press release, where they essentially said that although swings in net exports have affected the data, recent indicators suggest that economic activity has continued to expand at a solid pace. This is something I agree with, and I've made a video regarding this, that we've seen a spike in imports because of corporations and companies who try to avoid paying tariffs. So ahead of tariffs, they imported raw materials and so forth in order to have lower prices for and stock for a longer period of time. That's what they did. And as the formula of GDP takes out imports, so as imports grow, the GDP is smaller. And so because of this spike in imports, the GDP was lower, and instead of seeing a moderate growth in the fourth quarter of 2024, we've seen a moderate contraction. So this is something I agree with, and the economic activity has continued to expand at a solid pace. Then they later on said that the unemployment rate has stabilized at a low in recent months and labor market conditions remain solid. This suggests that labor market is still resilient, and despite all of the fears we've seen a couple of days ago of a potential stagflation, I've seen a lot of headlines actually, especially in the mainstream media, around the potential of early stages of a stagflation. So when we had the GDP coming out negative, we had the PCE core prices coming in higher than expected, and we also had the ADP employment change coming in much lower than expected. That suggests all of the indicators. So it checks all of the indicators of a potential stagflation. So you have low economic growth, high inflation, and an unstable labor market. So I've seen a lot of narratives around that, a lot of headlines around the potential start of a stagflation and the early stages of a stagflation. And this is just to farm engagement. And we'll talk about in a few minutes about the engagement farming part and how it plays a role into all this. And then later on, some stupid takes I've seen over the last couple of days that I want us to go on in today's conference. But returning to the Fed's press release, they also said that so they had this their monetary policies where they clearly covered that they kept the rates still, so they held the rates, and that they also kept quantitative tightening in place. So all of their quantitative tightening measures, their monthly redemption cap of treasury securities, they kept it at 5 billion, and they also kept their monthly redemption cap of asset-backed securities and mortgage-backed securities and so forth at 35 billion a month. So this just suggests that the Fed isn't worried about the state of the economy, which is why I believe it's a good sign that they kept their rates still. So they held their rates, they kept their quantitative tightening measures. This suggests that the Fed doesn't need to intervene, and this suggests that the economy is still resilient. Because let me tell you something. Once there is a change in monetary policies, once there is something that changes, that suggests that the current path that we're on isn't sustainable anymore. And we've seen this times and times again when the Fed needs to intervene, and that later on leads to a correction in the markets. The point is, when we have a period where the Fed needs to intervene, it isn't a good sign for the economy especially. It means that the current path isn't sustainable anymore and we need to do something about it. So there is a problem at the root that the Fed is trying to fix through their intervention. It is not something positive that the Fed needs to intervene and reduce rates or end their quantitative tightening measures. Now, I've made my case on this, and I think this has led to a lot of confusion out there, where I said that the end of quantitative tightening will lead to a risk-on period in the markets. And I think that a lot of people have misunderstood me by that, in saying that if the Fed ends quantitative tightening, then quantitative easing should start. Those two things are very different. And secondly, what I want to emphasize is that I believe the environment that will lead up to the end of quantitative tightening will be the one that will result in this expansion in the markets. Not quantitative tightening itself, but the belief and the sentiment leading up to it. So leading up to the end of quantitative tightening and the potential, and more rate cuts. That's what I think will lead to that risk-on environment where there is a lot of euphoria, a lot of positive narratives, and that fuels the risk appetite of investors, leading to higher prices in the markets and essentially a blow-off top in risk assets. Now, this has been my base case, and I think I have been misunderstood in saying that the end of quantitative tightening will prime risk assets. So I just want to bring some clarity in that. And I also want to emphasize that it's important to have an objective analysis. What we've seen over the last couple of days were we had these very volatile times where emotions get out of control, where there is really hard to control emotions. And in these times, it's just better to step back from the markets to reflect on the broader market picture and see all of the confluences that develop on the long term. So this is what we're doing today. We're reflecting on the broader market picture, and we're analyzing the broader market environment through the macro environment, Fed's policies, what's going to happen next in the next couple of months, and how we can interpret this. How can we use this to our own advantage? This is why I've said to avoid focusing on the short-term noise. It can either be the technical side, so whether we'll get a rally or a pullback on the low time frames, or it can be about headlines, about Trump making a deal, Trump not making a deal. It has gone back and forth. So without further ado, let's move on to the CME Fed Watch Tool. So the CME Fed Watch Tool, what we see here is there is currently an 80% probability of another rate hold in June. Now, I believe that the fact that the Fed isn't transitioning away from these rate holds, once again, it signals that the economy is still resilient and that the Fed doesn't need to intervene and doesn't need to change the path that we're currently on. That's my current take, and a lot of people have hoped for a rate cut in May. I believe that take is unwise, to say the least, to wish for an emergency rate cut. An emergency rate cut, especially when we were back in early April when the markets were crashing and people were saying that an emergency rate cut would follow next. That's an unwise take, in my opinion. Hoping for an emergency rate cut, and especially hoping that emergency rate cut would push the prices of assets higher, is a stupid take, to say the least. Because let me tell you something. The markets do not like one single thing, and that is uncertainty. Okay, so let's think about that for just a moment. If the Fed would cut rates sooner than everyone expects, or sooner than they should, and they intervene by changing their monetary policies, that leads to lower interest rates, that leads to more liquidity that can be accessed by corporations and so forth. But it raises a lot of questions that need to be asked. Why is the Fed intervening? Why is the Fed making these changes? Because especially in the economy, one action has impacts on a lot of different things and can spiral down into a very big thing. So one small action can spiral down into and have major impacts on the economy. So the Fed intervenes only when necessary. So if they would have cut rates, it raises a lot of questions. Why did they cut rates? What is the problem that they're trying to fix that they're cutting rates? So I believe that the fact that they kept the rates at 4.5% is a positive indication for markets, and we've seen that reflected in the price action. We've seen that with Bitcoin rallying over $100,000, with Ethereum pumping over 35% in 3 days. So that's the reaction that the markets have had, because there is a period of economic certainty. And I think that these are the first steps into this transition in a risk on period. Now, I've made my case on this, on how these assets will be impacted by a risk on period. And I think that the main catalyst, as I said, will be around the end of quantitative tightening. Not the fundamental side of quantitative tightening, but the psychological side. How it will impact the narratives and the headlines and the market sentiment. That's where I think our main focus should be right now. Because most times events have an impact before they actually happen, because the markets tend to be foreseeing to events. The markets tend to price in different topics, different events that could play out. And this is why I think we've seen the markets rallying starting from early April all the way to mid-April, when we had all the way to now, when we had that FOMC meeting. So in early May, this is why I think the markets have rallied, because the markets were pricing in rate holds, not rate cuts. So moving forward, I expect the Fed to continue to keep their rates at 4.5%. Looking at the probabilities, we see that in July, the CME Fed Watch tool is pricing in a rate cut, though I think we will see another rate hold in July as well. Or we could even see a rate cut. Who knows? I personally expect that here it is a 50-50% chance. My personal base case was that we could see the first rate cut in July, then later on see 2 more rate holds, but we'll have to see. I personally would like to see another rate hold in July, because if we see another rate hold, it will give us a whole lot of time for the markets to pump. Because let me tell you this, as long as the Fed keeps their rates high, as long as they do that, and as long as they do not interfere with the current macroeconomic environment, I personally expect that the markets will really like that, because of the economic certainty it brings and how easy it is to predict monetary policies. That's, in my opinion, something that fuels the risk appetite of investors. So that's something we have to pay attention to. So my current base case is that we could see the first rate cut happening in July, though I would like to see another rate hold here. It depends on the macro data that will come out in May and then later on in June. But as I said, I believe if we see a rate hold in July, that the first rate cut will be in September. In that case, I think it will be the most bullish environment ever, because it gives us a whole lot of time and the markets a whole lot of time to rally. So these are my current thoughts on the latest FOMC meeting and pretty much the whole macroeconomic spectrum. So the macroeconomic side, as I said, is in my opinion really important to track moving forward. I think it will tell us how the markets will move on from here, and most is so we have to pay attention to the macroeconomic side because of 2 main reasons. The first one, it impacts the correlation between risk assets and safe assets. And if you've watched some of my latest videos, I've covered this exact topic around how the end of quantitative tightening will impact risk assets from here on out, and how it could act as a catalyst to ending the underperformance of risk assets and against the traditional assets and the safer assets. So this is a topic we'll cover in just a few minutes. But for now, I want us to move on to another topic I've seen really popular on X. And personally, I wouldn't have covered this, but I've seen it. I've seen a ton of attention going to it, and I want to share my thoughts on it. So here we have a really interesting take I've seen before the FOMC meeting from a guy that said that the Fed will drop rates by 1% tomorrow, and let's send prices higher. Okay, so this implies that rate cuts will be extremely bullish for the markets moving forward. As I mentioned earlier, I think that if the Fed would cut rates so fast, so aggressively, and would intervene with such, would intervene like that, I think that it would mean that the Fed is trying to plug some very big cracks in the economy, and that leads to lower prices, that leads to crashes in the markets, that leads to a lot of uncertainty, that leads to spikes in the VIX. Okay, so for that reason, I don't think that rate cuts right now is what we want, especially of this amplitude. Seeing a 1% rate cut is significant. And okay, not to say that this is purely from a technical side, because if we were to truly see a rate cut of 1%, the Fed would simply go insolvent because of the bond market, because of the fact that the yield of the 10-year treasuries is at 4.3%. If the Fed would cut the rates at 3.5%, then they would simply go insolvent. So again, we're just covering the technical side here. In reality, it wouldn't have been possible for the Fed to cut rates in the first place, but we're talking about the concept here. So this is a post I shared, and what we also saw was in one of their so let me actually find a post I made here. Because this is really interesting. And okay, so we had this treasury auction of the 3-year notes. It was all good. The Fed has had some basic SOMA reinvestments. They rebought essentially the notes that have expired 3 years ago. So when they were adopting their quantitative easing measures back in 2021, they were buying a whole lot of these notes. They were buying bonds, they were buying treasuries, and so forth, right? But because we have had, and back in 2021, 2022, and so forth, when the Fed was having their quantitative easing measures in place. Because of this, this was 3 years earlier, 3 years ago, these notes have matured. Now what does the Fed do? When notes mature, they repurchase them, so their balance sheet doesn't go down, right? So that the banks do not have to give the liquidity back to the Fed just repurchase them. And essentially it is this whole scheme that is pretty complex, but not that complicated in reality. So they repurchased these notes. We had the SOMA account positive for $20 billion. So pretty good. But the point is, people saw this. People saw a positive SOMA for the first time in 4 years. So I won't bring back the posts I've seen on the timeline. But people were saying that QE is back. Quantitative easing is back. This is the end of quantitative tightening. With no proof of that. We had purely SOMA reinvestments that are normal. So there is nothing unusual about this. Nothing that could change the current state of quantitative tightening and so forth. So people started to call for quantitative easing. People were becoming extremely euphoric. This was all over the timeline. This exact photo was all over the timeline with people calling for the start of quantitative easing once again. And I've thought about this for quite some time, for some days. Think about how the sentiment will look like when the Fed will officially declare their victory against inflation. Think about that. If there were some simple SOMA reinvestments that the Fed did because of 3-year notes who have matured, and once again, this is not a big deal, only 20 billion. Think about it. How fast the sentiment changes from calling for a recession to calling for the beginning of quantitative easing, and how prices will go much higher. Now, this is something I believe will be one of the main narratives when Bitcoin and the broader markets approach the cycle top. And I've made my case on this many times before. But the fact that we've seen such a rapid shift in sentiment, I think only confirms that. And this is why I always emphasize and why I always cover in many of my conferences, many of my videos, the importance of having an objective analysis that is based on objective data and on the reality of the markets, not just what we would like to see. Once again, I think that the beginning of quantitative easing, not only that, but also the end of quantitative tightening, the act itself will not be positive for the markets. It signals that the Fed is trying to make a change, and the Fed is intervening because the current path that the economy is on right now isn't sustainable anymore. That's what any change in monetary policies implies. This happened back in 2022 when the Fed transitioned away from their quantitative easing measures to their quantitative tightening measures. They started reducing their balance sheet and so forth, leading to lower liquidity in the markets. That's what they did because the current path that the economy was on right now, that was leading to more hyperinflation, wasn't sustainable anymore. So the Fed had to intervene. The same thing is happening right now, where the economy is gradually weakening, even though we've seen how resilient the labor market still is, and that inflation is under control right now, and that once again we're having a moderate growth in the economy, even though we've seen that negative GDP. I think that if there weren't for those imports and spike in imports pre-tariffs, we should have seen a moderate growth instead of a moderate contraction. So the economy is still strong, but it is weakening. So the Fed will have to do something in the coming months. And once they actually intervene, that's when I think we could reverse the current uptrend that we have started in early April. Of course, there will be ups and downs along the way, but I think that the general trend right now is upwards. And that, I think, will lead to higher prices in the coming months. But don't forget what that implies. Don't forget what higher prices mean. Don't forget what this risk on environment precedes. Because I've made a post on this that has made a lot of people upset. That this risk on environment, even though it will be extremely bullish for the markets, there will be a ton of money that will be made, that has already been made since we bought a couple of weeks ago. This precedes a very big bear market and a recession ahead. This is what it precedes. Because this risk on environment will be what market makers want and what market makers make up and manufacture in the markets to make retail FOMO at the top while they distribute. Through this risk on environment, they create for themselves an artificial counterparty that they can trade with. This is why all of these positive narratives will make a comeback. Everyone will start embracing the end of quantitative tightening, how new liquidity will enter the markets, and make the prices of risk assets and equities go much higher, how we shall see a soft landing ahead and new liquidity, and how everything is so fine, and the super cycle narrative. That is something we'll cover in a different conference or a different video. I have a video planned for that. It is a really interesting topic there, the super cycle narrative. All right, so don't forget what all of this leads up to. And I've made my case on this. I am bullish on the high time frames, don't get me wrong. But I think that, and I've personally used this whole risk on environment concept and idea and prediction in order to predict the next bear market. What all of this leads to. And I've did a very similar thing right now in early April, where I said, if you guys remember, in some of my past videos, I covered a series of untapped lows that developed on the low time frames and preceded liquidation cascades. And I've made my case on this that led essentially to short-term pain for long-term gain scenario, where we had short-term pain in the markets, but that later on preceded long-term gain for the markets. And we're currently in this exact environment. We had a short-term pain, and now we're in the long-term gain scenario where the markets are outperforming once again. We have bulls back in control. Bitcoin is back above $100,000. This is the long-term gain scenario that I covered. And by thinking about what preceded this long-term gain scenario, we needed to have the short-term pain first, okay? And now we're in the exact opposite of things. We're having this gain momentum, this risk-on period that precedes the next bear market. This is how things work. This is how market makers manipulate the markets and the sentiment to make retail bullish at the top and bearish at the bottom. It has happened throughout the entire history of the markets. So this is not something new. This is not something I have discovered, but it is something universal that we need all of us to understand of how market makers operate and how market makers create an artificial counterparty out of retail investors. So with that said, I want us to move on to the S&P 500 chart, and specifically to how these interest rates have impacted the S&P over time. If you look at something really interesting that has happened back in 2023, when a lot of people, I don't know if you guys remember this, but a lot of people back in October of 2023 were calling for this bear market rally, saying that this was still a bear market. We haven't ended the bear market. This was the first initial correction. Then we later on had this bear market rally that will later on resume in a continuation of the downtrend. This is how the sentiment looked like back in 2023. And the main argument around this was a liquidity crisis in banks, liquidity going down and interest rates being at record highs. So levels that haven't been seen since 20 years ago, back in the early 2000s. And a lot of people said that, and they were wrong. They were wrong because they didn't take into account one thing. And this is something extremely important that a lot of people overlook. And that is the relative investor confidence. How investors feel about the markets. This is something that we have to think about before we invest. How does the sentiment impact the markets? What we have seen, even though the Fed was at record high interest rates, we have seen this major bull market. The reason is a lot of people felt really confident about the economy. Throughout all of these years, we've seen essentially a Goldilocks environment with a stable and relatively low inflation rate, a stable economic growth and high economic growth, and a resilient and strong labor market with a low unemployment rate, strong non-farm payrolls, strong ADP, employment change, and a lot of other macroeconomic indicators that were pointing towards this Goldilocks environment. Now, the Goldilocks environment, for those that do not know, represents the best environment possible for the markets to be in. The reason is not just from a fundamental perspective, because in a Goldilocks environment, businesses are primed for growth, as we've seen the case with the whole AI sector that attracted the investments and that has grown so much since 2023. Not just from a fundamental side, but also from the sentiment perspective, where monetary policies are extremely predictable. We have this strong macroeconomic environment, and because of this, it leads to a higher degree of risk appetite, with investors feeling very positive about the markets and investing into these equities. This is what has happened in 2023 and all throughout 2024. And yes, you can use the narrative of AI. You can do that. You can say that, okay, we had the AI growth, we had all of that, but where did it come from? It came from this Goldilocks environment and high degree of risk appetite. That attracts investments, that leads to higher prices in equities, and especially to higher prices in risk assets, as we've seen with Bitcoin. Bitcoin rallied since October of 2023 all the way to March of 2024. So in a matter of a few months, it rallied from $25,000 to $75,000. And that is a 200% increase. So we've seen that. And now we've seen the opposite. We've seen the opposite of how sentiment impacts the prices. So here we had a lot of investor confidence, prices going higher, everyone feeling confident about monetary policies and the geopolitical environment and so forth. Then we had the opposite, how uncertainty impacts the markets. Headlines changing on a daily basis, right? So that leads to a lot of uncertainty. Not even the Fed knew what was going to happen next. They said in many of their conferences that they'll wait this out and that they won't make a stupid decision to rush into making a shift in their monetary policies, as I've seen a lot of people desiring for the Fed to rush into this change in their monetary policies. Once again, it can spiral down and ripple throughout the whole economic environment and have unwanted effects, which is why rushing into a decision, especially when talking about the Fed, is not a good idea. We've seen this exact thing happening back in 2020, and that has led to 9+% inflation. Right? So this is why I think that it's best, and it's such a good indication on where the markets are heading, because the Fed is able to wait this out, and the Fed is able to do the best decision possible instead of rushing to decision to cut rates, to that emergency rate cut, to the end of quantitative tightening, and that can lead to a lot of mistakes. So I think it's a very good indication that the economy is still resilient and that the Fed doesn't need to rush. The fact that the Fed doesn't need to rush has bigger implications and than everything else, right? If the Fed needed to rush and needed to make a change, that would be bad. And the markets agree with me. As we've seen over the last couple of days, the market's going up and Bitcoin also going up, which is what we'll cover in just a few minutes. So the markets agree with me. The markets agree that we need this investor confidence and a high degree of risk appetite to go higher. Now, I believe that equity markets and major indices are topped out for this cycle. I personally believe that. I believe that it's likely we'll see major indices go into this complacency phase where we have this distribution with a ton of volatility, which allows market makers to distribute. But I believe that in this range, we'll have our main focus on risk assets. I believe that while equity markets and traditional indices such as the S&P 500, the QQQ, the DJI will be in this complacency phase that later on precedes this crash and bear market. We'll have a risk on environment where risk assets will outperform, and we'll have some pairs that we'll cover in just a few minutes. But the point is, when the Fed will continue to keep their rates at 4.5%, so if they keep them until September, that would be great. That this would look something like this. It would give us some additional months where the markets can have this complacency phase, and we'll have the blow off top in risk assets. That would be great before seeing our first rate cut. The rate cut in July, would also be okay. If we look at what happened in the previous cycle, back in 2019, 2020, when the Fed also kept the rates for a couple of months, had this period where they transitioned away from their quantitative tightening measures. This is exactly what is currently happening right now, and what I think will happen moving forward, where the Fed is holding their rates. People are starting to believe in the idea of a soft landing, and then we have some sort of global event. Now, don't focus on the global event all too much. Don't focus on the narrative. Focus on strictly the correlation between Fed's actions and how it impacts the markets. Do you see what happened here? So forget the narrative part, the pandemic side. Forget it. Look at this chart. Just look at this chart. Look at how the markets reacted from the Fed cutting their rates so aggressively back in 2020 and making a big change in their monetary policies to stimulate the economy. Do you see what happened? Did the markets like it? No. Because the Fed doesn't intervene with no reason. The fact that they have reduced their rates so fast and so aggressively represents that they were trying to fix a big economic problem. And what precedes these moves to the downside is a risk on period, where the markets gradually go up, where everyone screams for a soft landing and a Goldilocks environment, a super cycle, so forth. There are a lot of narratives that can emerge. But I believe that the main one will be around the potential end of quantitative tightening and a soft landing ahead. This is exactly what has happened back in 2019, leading up to the pandemic. And if you look at this chart, when the Fed was holding their rates, the markets were going up. We were in this exact risk on environment that I'm predicting right now we'll see in the next couple of weeks and months that has preceded eventually this crash. I don't know if we'll see a similar crash to this or more of a traditional bear market where we have a couple of months of downtrend before we resume to the upside. We'll have to see. But now we have to focus on what's going to happen in the next couple of weeks, and I believe we're in this phase of risk on period. The Fed is holding their rates. The Fed is not making any changes in their monetary policies. This leads to a higher degree of risk appetite, and in this case, right, we are not exactly in the same environment we've been in 2019. In this case, I think the main focus will be on risk assets. So moving to our next chart, the IWM to XPX pair. I'm sure many of you are familiar with this chart. I've highlighted it many times before in my past conferences and videos, but I think it's one of the most important charts out there. And it's telling a pretty important story about the correlation between risk assets, safe assets, traditional equities, and how monetary policies impacts all of this. What we've seen over the years was the Fed in this quantitative easing environment to stimulate the economy back in 2020, 2021. And because of this, small caps have outperformed the traditional and safer equities in the S&P 500. This is what we've seen back in 2021. Because of this, a lot of people got really euphoric back then, and a lot of people were embracing this narrative. Now, quantitative easing primes these small caps from two main perspectives. The first one is from the fundamental side, which is essentially how it impacts their business model as a whole. Essentially, what we see is the Fed. What we see with these small caps is they need cheap financing. They need to grow their business models and they need to develop. So because of this, a quantitative easing environment primes that exact thing. When they don't have cheap financing, so the small cap industry, the small cap sector as a whole is very competitive. They fight for who has the most growth or who has the most growth potential, right? They essentially fight for that. Investors look for undervalued small caps who have the highest growth potential. This is how small caps perform. Because of this, they need cheap financing in order to grow their business models. So in a quantitative easing environment, they have that. In a quantitative tightening environment, however, investments generally do not go to small caps. And the small cap sector as a whole remains competitive, right? That is what defines small caps. So they need to appeal to different ways of financing. This is what we've seen with Bitcoin miners, for example, and them diluting their shares over the years. Not only because the sector of small caps is competitive, but because the Bitcoin mining industry is competitive. And so Bitcoin miners have essentially found themselves in the most competitive environment out there, with global hash rate entering a parabolic phase. And because of this, a lot of Bitcoin miners couldn't keep up with the pace, need to enter other business models. We've seen some Bitcoin miners entering various branches, such as the AI sector or the high power computing sector, to diversify their business model because they couldn't keep up with the competitiveness of the Bitcoin mining industry. So there's that. But the main point I'm trying to make here is not about Bitcoin miners, but it's about how quantitative tightening has impacted small caps. And not only small caps, because here we're focusing on the broader concept, not on a small concept. How it impacted the correlation between risk assets, so small caps in this case, and traditional assets. The traditional equities in the S&P 500 in this case. We see that over the years it has bled. And it has bled because the big investments went into the traditional equities that had the most growth potential. Once again, in these types of environments, from a fundamental side, risk assets cannot outperform because investments do not go into small caps because of their business model, because of the competition that is out there. So because of this, we have seen these risk assets bleeding. But if we think about this, if we think about how quantitative tightening has impacted it, the total assets going down, what will happen when quantitative tightening will go away? What will happen when people will realize that we're nearing the end of quantitative tightening, and when the Fed will finally declare their victory against inflation? What will happen then? What will happen when the total assets finally bottom out after so many years, and the main factor that has led to this underperformance of risk assets against traditional assets goes away? I think we'll finally see a rotation towards risk assets, something similar to this, risk assets outperforming traditional assets for the first time in years, leading up to the cycle top and micro top, whatever you want to call it. Right? I think we'll see this for the first time in years. And once again, it all comes down to how the S&P 500 will also perform. Moving on from here, I personally believe that it will be something similar to this complacency phase where it chops while risk assets go up, leading to this outperformance of risk assets against traditional assets and leading up to the cycle top formation. Now, if we think about this, we need one main factor to change this, and that is a high degree of risk appetite. Investors being willing to make these risky investments. That's what we want to see. And for that, we need a very strong narrative. Now, I believe that narrative will be around the end of quantitative tightening and a soft landing ahead, which fuels the risk appetite. Now, we have a very similar pair in the crypto market, which ties to how altcoins perform against Bitcoin. We find a very similar correlation. When we were in this quantitative easing environment, back in 2020, 2021, altcoins were outperforming Bitcoin by a large margin. When that ended, however, in 2022, when the Fed started to raise their rates, start to sell their assets, marking the top in their total assets, that's when altcoins start to bleed against Bitcoin. But now it finally seems like we're nearing the end of this underperformance. And from a technical perspective, for the first time in years, we have this bottoming formation that has formed since November of 2024, and that has led to this bottoming formation with the total 3 and Bitcoin pair not really going all too much down and continuing this downtrend, signaling that we could be finally seeing this change and reversal in altcoins against Bitcoin. Now, once again, I think that the main narrative will be around end of quantitative tightening. But don't forget when alt seasons occur. Alt seasons occur. So, moving to the Bitcoin dominance. Alt seasons occur only in top formations. Only when Bitcoin tops out for that cycle. And the reason why I went to the Bitcoin dominance chart is to show you how it impacts all of this. The Bitcoin dominance tells a really interesting story, and that is it signals where liquidity is going in the crypto market. The crypto market is so easy to trade in because you have all of these indicators which show you, if you learn how to use them properly and how to see them as a whole and understand the broader environment, they help you so much because it tells you exactly where liquidity is going. It tells you exactly where the sentiment is. And what we've seen over the years, what people fail to recognize is that the Bitcoin dominance going higher signals that the cycle isn't over just yet. And a lot of people have hoped for an alt season, when we were around $30,000 back in 2023, when we were around $40,000 back in 2024, when we were even at $60,000 to $70,000 back in this accumulation phase in 2024. People were continuously screaming for an alt season over and over again because they thought that altcoins normally should outperform Bitcoin. And that is false. That is false because a lot of people have entered back in 2021 when, yes, we were in a quantitative easing environment and altcoins were outperforming Bitcoin because of that. Because in a quantitative easing environment, we have a different correlation between risk assets and traditional and safer assets, which is why paying attention to monetary policies is so important. Now, throughout this cycle, we've had continuous calls for an alt season. Back in December, I personally thought that we'll have our first alt season. And the reason is, when we see these alt seasons, it marks the cycle top. I personally thought that we'll have the cycle top formation for the first time then, because of some calls I made back in September saying that the $100,000 to $110,000 range will mark the end of this bull market. And so we had this initial wave down, this bounce up, and then later on I said, okay, it's clear where we're heading next. We'll have another leg down. And this marks the end. But I was wrong on this. And the Bitcoin dominance kept on going higher and higher. And I used it as a very strong confluence in my analysis to flip my bias from saying that we have topped out for this cycle to saying that will see a big leg up in the next couple of months. So I flipped my bias. And for that reason, I also flipped my strategy from calling for a bear market when I de-risked back in December to calling once again to a major leg up in the coming months and reaccumulating in early April, repositioning myself for this exact leg up. I used Bitcoin dominance as a really strong confluence, and now I'm using it as well to identify whether this is a complacency phase, which it can very well be for Bitcoin, or whether we'll have one final leg up. So I've seen some questions in the comments around the Bitcoin dominance going down. And yes, this is an important confluence that I'm currently tracking. It's going down. We don't have enough signals to say that this is a clear crash. Though I will continue tracking this, I think it is one of the most important confluences out there. And I said this many times, if we see the Bitcoin dominance crashing and altcoins start to massively outperform Bitcoin while Bitcoin fails to form a new all-time high, then we could be very well in a complacency phase that precedes a continuation lower, failing to form a new all-time high. So this is essentially how we want to adapt on new market circumstances. This is how we want to use and how we want to remain flexible and adapt ourselves to new market circumstances. This is how we want to do it. We don't want to keep a bias for too long if circumstances change, but change from a fundamental level, not just how the price action develops and so forth. Because I've seen a ton of people do that, saying that they're adapting, but they're just flip-flopping because we've had a red day and then we later on had a green day and they flip bullish. That's not how you do it, because at that point you'll just lose money and buy the top then sell the bottom. But you want to do it in a durable way, and you want to, when you change your bias, you change it for a longer period of time, and you changed it for good reasons. For example, back in early April, when everyone flipped bearish, when everyone was calling for a recession, what fundamentals did they track? What fundamentals were there involved in calling for a recession? Was the economy weakening? Was the labor market weakening? Was there a major spike in unemployment, or some crash, or some big event going on? No. So despite all of the tariff fears, which are now completely solved because it was a self-induced correction, we didn't have any narrative, we didn't have any headline, we didn't have any fundamental that would sustain a bear thesis at that point. And even such, if people were really bearish, then they would simply wait for this complacency phase to develop. They would sell now, for example, once the price has reached $100,000. So that's how I adapt myself. And I've used the Bitcoin dominance to see the story between risk assets and traditional assets. And once again, I've used the Total 3 and Bitcoin pair to see the story once again, and I've tracked the monetary policies and the macroeconomic environment to gain a complete understanding on what's really been happening behind the scenes and what we should pay attention to and what impacts this correlation between risk assets and traditional assets. So moving on, we have the USDT dominance. I've made a video on this. I don't know if you guys have watched it. We were around these levels when I made a video in saying that there was this rising wedge that developed. Now, when the USDT dominance goes lower, it signals that there is a rotation from safe assets in the crypto market, which in this case are stable coins, to risk assets, which can either be Bitcoin or altcoins. And I've made a video on this in saying that we were seeing a rising wedge that could precede a crash in the USDT dominance. And we later on had this breakdown from this rising wedge and a rally in the crypto market. Now, I've used the USDT dominance in many times before Once in October, and I outlined the post in the video I made, once in October and September when we were at these levels, and I said that, you know, we were testing at that moment a pretty important resistance range. So it is this one, which we tested in early April, which also was a strong confluence for me to say that we have bottomed and that we will go higher. This is a very strong confluence that all of you can use. The USDT dominance, we had this resistance range that we tested, and because of this there was a very high likelihood that we will bounce off of it. So I used it back in October to say that we'll have a major rally ahead, and I also used it back in December to sort of de-risk my portfolio. We were testing a pretty important support range. So there was this support range, let me highlight it for you, which is a pretty substantial and a pretty important support range, a very high time frame support range, which really has started back in 2022, and as you see here it has bounced many times off of it. So I made my argument that because of the fact that we were testing this support range from which we've seen a bounce from in March, and we also had some bullish confluences developing on technical indicators, I made my case that it was a good time to de-risk, and I was right. But then later on we went up, we tested this resistance range. This was a good time to buy. Sentiment was at an all-time low. A lot of people were fearing a potential recession. A lot of people were calling for a bear market. So you have all of these confluences that line up perfectly. The Bitcoin dominance going up, signaling that liquidity is still flowing into the traditional assets and that the bull market is not over. The USDT dominance testing a major resistance range. We have, you know, deals being made on the geopolitical side by Trump, and tariffs, all of the tariff uncertainties going away. We have a major macro catalyst ahead of us, which is the end of quantitative tightening, as the inflation has currently reached the lowest point. So the CPI year over year has reached the lowest point since September of 2024, when the Fed has reduced rates for the first time in 4 years. So you had all of these confluences and people were calling for a bear market. You know, so there comes the question on how emotional are people? And how much do they pay attention to the confluences that confirm their bias only? So this is why I always emphasize that it's so important to have an objective analysis and not just look on the confluences that confirm your personal bias. This is why I always seek opposing views than mine, because opposing views are the ones that can bring you a more complete picture, can bring you some information that you have missed in your own analysis. So this is why I always seek that. And a lot of people were calling for a bear market. I seeked seeing their perspective. Well, why are you calling for a bear market? Well, tariffs and, tariffs and... I mean, it doesn't make any sense. So that's what I want to emphasize. With a phone call, all of the tariffs uncertainties were solved. And yeah, that's pretty much what I want to highlight there. Now we have another interesting chart out here that we want to pay attention to, which is the ETH to Bitcoin pair. The ETH to Bitcoin pair, what we've seen over the last couple of days was this inverse head and shoulders pattern that developed. I highlighted it on my X account as well. And I said that, because of this, it can finally lead to this bounce to the upside, which it did. The ETH has outperformed Bitcoin over the last couple of days, and people are starting to wonder, is this finally the time? Is this finally when ETH outperforms Bitcoin? Because what we see here is a pretty long downtrend. Once again, I think that we'll have to see a sustainable macro catalyst and a durable change in monetary policies, or people knowing, the markets knowing for an absolute certainty that we're nearing the end of quantitative tightening. That's what I think we'll have to see to finally have an alt season and ETH to outperform. Could this be front run by the prices? Well, certainly. I think it is definitely a possibility to see ETH front running this whole end of quantitative tightening and so forth. It could very well be a possibility. Though I'm currently paying attention to this. Normally, what we've seen throughout the past years is a spike in this ETH to Bitcoin pair, which later on fades, and all of the gains that are made in Ethereum then later on bleed into Bitcoin. So pay attention to that. And certainly I think that on a technical perspective, this place would be perfect for bounce and for bottoming formation, right? So we have this major support range that, yes, I think this could certainly serve as the bounce place. I think this could certainly serve as the, the place where we have a durable bounce from, and where this downtrend reverses. So yeah, I think it can certainly be a possibility. On the low time frames, I'm currently tracking some confluences. We had this bottoming formation, which has lasted for a couple of days, which we didn't see until now. Until now, we had this downtrend, and then later on, this reversal that faded. We didn't have like a bottoming formation that formed that later on preceded a move to the upside. So, there are some really interesting confluences that have developed, so I think it will be worth watching how it develops moving on from here. Though what I would like to see, however, is Ethereum continuing to bleed against Bitcoin for the next couple of days and weeks until Bitcoin forms a new all-time high, and then later on goes to upper levels I highlighted in some of my prior videos, the $140,000-$160,000 range, and then later on start the distribution phase where altcoins finally start to outperform. Because if altcoins start to outperform now and the Bitcoin dominance goes lower and Ethereum outperforms, we could be in that complacency phase scenario where Bitcoin fails to form a new all-time high, and we find ourselves, calling for new all-time highs, but we're actually in a complacency phase. So that is something that I'm currently paying attention to right now. And once again, yes, this is definitely exciting to see Ethereum outperforming for the first time in such a long while. But it also brings some warning signs that we have to pay attention to. So moving to a post I made here is the fact that don't forget that a real crash in the Bitcoin dominance typically aligns with the actual cycle top. And, the fact that the Bitcoin dominance is still climbing tells me that the bull market is still intact. This is a post I made. This is something that we have to pay attention to. Another post I made was that this space can flip from panic to euphoria real quick. This was made in April, actually, in mid-April, when everyone called for a recession, when we had retail capitulating on Bitcoin with the Google searches and so forth. So it's easy to forget how fast sentiment shifts when you're in the thick of it. And it definitely seems like I was right on this. We have certainly flipped from complete panic and anxiety and disbelief. Here I said in just a few months. You could say I was wrong on that. It was just in a few days. People are chasing green candles and calling for new all-time highs. This is how fast sentiment shifts, especially in the crypto market, which is extremely volatile. So it's easy to forget how fast it can change. But you know why it changes? Do you know why it changes? It changes because people don't have conviction in their analysis. People don't have objective data and an objective analysis that they stick to. This is why the sentiment shifts so much. Because we have volatility And because people do not have an objective analysis that they stick to and that they track, and objective scenarios that have certain confluences that could develop, like I do with the cases I outlined earlier, with the potential of a complacency phase if altcoins continue to outperform and Bitcoin fails to form a new all-time high, or my base case that implies we still have another leg up and a rotation and a transition to a risk-on period and environment led by the euphoria coming from the potential end of quantitative tightening and the narratives around soft landing. So I have certain confluences that need to develop in order to have a specific scenario. And if we have those confluences emerging on the charts or on the news or on the headlines or on the macroeconomic data, then I stick to that scenario, which is objective by any means. But people do not have that. And then we have price volatility because it is the crypto market after all. And then they need to appeal to something. They need to appeal to some sort of confirmation that would take their fears away. So they appeal to mainstream media most of the times, or to news, or to headlines. So people say, they don't watch mainstream media. So they look on Twitter, they search for the headlines, and then we have all these influencers, so-called influencers and chartists, who cover a complete fake story. Like we've seen the case with the 1% rate cut right now, I showed you earlier. Those are complete fabricated stories that you must never track. So you have your objective analysis, that's the best way, and then you look on the confluences that emerge. And you never take someone else's opinions and as if they were your own. Because if you do that, then first of all, if it ends up a failure, if it ends up being mistaken, the problem is you learn nothing off of that. And I explained this many times before. The only way you can improve is by sticking to your own system and see if it fails. If it fails, then it's good for you because you've learned something. If it doesn't, then you make money, right? So you win in both cases. That's how I perceive it. But if you don't have your own analysis, then you just take someone else's thoughts as if they were your own, and you learn nothing from that. So that's the problem, and that's why I think sentiment shifts so much, because we have volatility and we don't have conviction in the retail analysis side. And because of that, we have these changes in sentiment, depending on how the price actually looks like. Now, I want us to have a look at a post I made in early April. So this is where Bitcoin was around $70,000. When we were crashing, when everyone was extremely fearful, I made a post that at the time seemed very contrarian to how most felt, where I said that the sentiment is rough, the fear is high, and after a sell-off like this, it's easy to feel like the worst is yet to come, which is what most thought, that we would enter a bear market and that a recession was next. But this is exactly the time to step back, stay grounded, and focus on the bigger picture. This is where you want to step back and focus on the bigger picture. So right now, at the time, I believed that was a good opportunity to gradually build core holdings. And I wasn't saying that because it was easy or because the prices have dipped. But I was saying it because historically moments like these have preceded major moves to the upside and have been the best times to buy. And I publicly said in this post that I had the lowest cash positions I've had since 2022. So I publicly said that I wasn't afraid of the heat that would come after that if I was wrong, because I knew that the fear was too exaggerated. There was too much irrationality in the markets in order for that to be the start of the bear market. And so far, I was right. I've then since de-risked a little. I've increased my exposure to cash a bit because that's what I generally do. I personally want to have an exposure to cash. Even though I'm bullish, I want to have a cash in my portfolio, 5 to 7%, just to be prepared, especially after aggressive moves to the upside like we've seen over the last couple of days. But nonetheless, this is where I had lowest cash positions. I have DCA'd all of the profits I secured back in December. I have DCA'd all of the profits I secured from my protective short positions I took by hedging at range highs and so forth. And I DCA'd everything I bought spot holdings at that time. That's where you want to buy. So that's what I did. And I said this back in this post that back in December I thought the $100 to $110,000 range would be the cycle top formation, and now I think that we're headed higher in the coming months. And then I said that we'll revisit this and see how it plays out. So yeah, this is something that we'll have to pay attention to. Also, I emphasize my analysis and my thought process on this onto the liquidation cascades leading to the short-term pain for long-term gain scenario, where we had those liquidation cascades, those corrections and pullbacks that later on preceded a long-term gain scenario. And now, as I said a couple of minutes ago, that this environment precedes, this risk-on period precedes the next bear market. So this is also something we have to pay attention to. This is around being a contrarian, and being a contrarian isn't easy. Being opposed to the mainstream sentiment isn't easy, right? But it is profitable. So I was a contrarian back in August of 2024 when everyone was mostly screaming for a recession, and I stayed bullish. If you guys remember that, I was hosting a lot of videos, a lot of conferences, I made a lot of threads, a lot of posts on that we'll see that major leg up to the $100,000 and $110,000 range later on to top out. And then later on, because I said that we would top out in November to December, while most expected higher prices, I leaned against the hype. I stick to what I believed in, and I de-risked. And then once again in early April, I kept accumulating, and it is all public, right? You can check it. I made posts on this, I made threads on this, I made videos on this, I held conferences covering my thesis and my thought process throughout, the years. So it's all public, it's all out there. And what I want to emphasize is I believe having an X account like this, not only it makes me public, right? It makes me certainly a target. If I'm wrong, I'm a target. But I think it can act as a journal, as a trading journal where I can reflect back on my mistakes or my successes and see what went wrong or what went right. And this, I think, is how I can learn, and I've learned a lot of things over the years since I started doing this. So having a journal or journaling your own journey, let's say, your own investment decisions, how you feel, why do you feel like it, the fundamentals to track, and so forth, I think are a very useful way that you can improve your own trading skills. So for anyone who looks or who seeks to improve, this is certainly a good way to do it. So this is where I said that another post I made, that on the next leg up I will de-risk everything. And I say this because I want to be ahead of time to just be public about this. That I accumulated, do I believe that this phase precedes the next bear market. So on the next leg up, I'll look forward to de-risk my portfolio a lot. So moving forward, as an end note, this is my weekend update. So it's a series I started back in early January of this year. a series of weekend updates I do on a weekly basis, so each Saturday, where I share my thoughts on Bitcoin. These are detailed posts. I think I will also make videos around the weekend updates, so let me know in the comments if you would guys like that. I think it would be a great addition to what I'm currently doing right now with these weekend updates. I said in my latest weekend update that since my last perspectives in early April, when I said that we were, from an Elliott wave standpoint, entering this final wave down in this high time frame demand zone from which we'll see our next bounce. Since then, we're currently sitting at $104,000. So it's been a while, and everyone thinks that the bull market is finally back. But I want to cover my current stance on Bitcoin from an Elliott wave standpoint. If we were to track what I said a couple of days ago, so back in early April, with the Elliott wave count I shared then, which implied this corrective move. So the initial corrective wave, this wave 1, this then wave 2, wave 3, wave 4, and later on this corrective wave 5 into this high time frame demand range. If we were to stick to this, then we could have this count, I think. On the high time frames, it seems like we have bottomed here, and then we have started this first impulsive wave 1. That seems to be nearing an end, because we had essentially a completed 1 to 5 corrective impulsive move, right? Now we could see this corrective move, corrective wave 2, that would precede the next impulse up, and this major breakout as a impulsive wave 3. So what I'm currently watching in the next couple of days is this wave 2, which is essentially the make or break moment. So we can either have a true corrective wave 2, which would imply a price pullback, and this would shake out the longs, and also I think it would create the perfect bear trap before this strong wave 3, with people calling for triple top, and we're not going to form new all-time highs, and essentially a continuation of the emotional volatility, let's say. So people flipping from a state of euphoria to a state of fear and bearishness once again. We could see that, or we could see another sideways consolidation where price just ranges under this high time frame resistance range as the sell pressure gets absorbed, which then later on precedes a breakout. So in this case, we wouldn't have a meaningful retrace in the price. In my opinion, both scenarios are valid, but I think that in order to know which one will play out moving forward, we'll have to track the data. And that is the funding rates, the open interest, and the futures premium versus spot. Over the last couple of days, we've seen the open interest going down while the price was going up, which suggests that a lot of shorts got squeezed throughout this rally. And this is essentially something I covered in one of my latest updates a couple of days ago. So this was made on May 5th, where I said that I made a very interesting finding, and that is that each of the local tops in the price has coincided with local bottoms in the funding rates. Now this suggests that shorts are protected. So each time there are shorts on the low time frames, they get protected. There is spot sell pressure coming in to protect those shorts and to make the price not go any higher to squeeze those shorts. That is how they get protected. We've seen a very similar incident happening back in 2024 throughout that accumulation phase, where the range highs never got tested or never got swept before there was the actual breakout straight to $100,000. So I made the argument, this was the main argument I said here, and the way I interpret this, shorts are getting protected on the short term, making bears feel comfortable shorting, which could lead up to a bigger short squeeze ahead. This post was made around $94,000, and it did lead to a major short squeeze to $104,000 currently. So this is the short squeeze, the price going up while the open interest was going down. Right now, what I would like to see as we're consolidating under this high time frame resistance zone is the open interest climbing gradually, which would mean that fresh positions are opening, ideally from shorts, funding rates flipping back into negative territories, showing that everyone is expecting a dip, and that there are more shorts than longs, which would set up a perfect scenario for a short squeeze ahead. And lastly, the spot to future divergence, so the premium metric going into negative territories, deeper into negative territories, signaling that the future markets are pricing in a dip while the spot prices aren't. And there is a lot of strength on the spot side and on the buyer side, which generally precedes moves to the upside. So that's the game plan moving forward. And this is pretty much what I will watch next for Bitcoin and the confluences that will develop moving on from here. So with that said, I think this pretty much wraps up our weekly market wrap up. So it's really been an interesting talk, and I really enjoy making these conferences. So if you enjoy them as well, make sure to show your support in the comments or spread the word about what we do. It is really appreciated and really supports what I do. So with that being said, this is pretty much what I'll be tracking next. These are my thoughts on the current macroeconomic side, with all of the correlations between the risk assets, traditional assets, how the Bitcoin dominance plays a role into all of this, how we can track them. This session has been recorded. I'll post the recording in a couple of minutes, so make sure you stay tuned for that. You can review it later. Thank you all for joining, and I wish you all have an amazing weekend and an amazing evening ahead. See you guys in the next one.